2010s, a decade in review for the stock market. We're going to look into this. It actually goes back a lot more of pretty interesting information here as well from Dimensional Fund Advisors. I'm not sure how I came up with this article, but I'm a big fan of DFA. This leads a lot to be concerning to me. So let's dive into this. We'll talk about this. I'm actually pretty. I found a lot of info in here that I want to share with you. All right. I'm not sure when this was written. Let's see. This say I'm not sure. All right. Let's see. 2010's a decade in review. It was 10 years of economic uncertainty. Blah blah blah. And global stocks more than doubled their value. Okay, so basically right here we see this the MS Morningstar something International, Capital International. I can't remember. But anyway, all world index that includes the U.S. You start with 10,000 in 1 January 2019. You ended with 23,473, 31 December 2019. So that's did I say 2019? 2010. You start with $10,000 in January 2010. You ended with 23,473 December 2019. Not too shabby. Imagine it's early January 2010, and you're reading a review of the financial markets. Investors have been on a roller coaster over the past 3 years, living hell, the past 10, man. What are you talking about? They then experienced a recovery that began in March of 2009 and is still going strong. But you didn't know that in January 2010. I mean, it's easy to say in hindsight it was March of 2009. It's kind of like, are we in the recovery now? I don't know. Are we going? Is it a big dead cat bounce? Or are we going back south? I don't know. You don't know either. You don't know until 5-10 years go by. Investors who wrote out the market slide are beginning to be rewarded, but the rebound is 10 months old. We're going back to January 2010 here. And markets have a long way to go to their previous highs. Opinions are mixed. A January 29 headline in the Wall Street Journal underscored the uncertainty. Bull market shows signs of aging. That was in December 2009. All right, so oh, geez Louise. March 9th of 2009 was the bottom. Look, man, they're always pointing out the bull market shows signs of aging. Bull market grows on a wall, what do they call, a wall of worry. It's just the bull market increases because of low interest rates. That's crazy. The publication pointed out that although stocks have rallied and indices are on the rise, worries are mounting in some quarters that the market is running out of steam. From the vantage point of early 2010, you might be wondering whether to stick to your investments or move to cash and wait for more evidence that things have recovered. I'd never understood. What does that mean? If you're going to do that, what does that mean that things have recovered? That they're up 20% than they are now? Or they're down 20% than they are now? You have to have a definitive time if you're going that route to get back in. Or no, I don't care. I'm just saying if I'm sitting there thinking, I'll wait till things have recovered or if things have settled down, what does that mean? Are things settled down when you're 20% higher? Well, you missed the 20%. Are things settled down when they're 20% lower? I don't think they're settled down then because people say, oh, it's going to go to another 20%. On a total return basis, global stocks more than doubled from this time, as we talked about. Despite positive annual returns during most of the decade, investors had to process ever-present uncertainty, blah, blah, blah. The decade also brought technological advances. All right, okay. Looking back, you conclude that the decade had a share of uncertainty, just like the decades before. But overall, the U.S. equity market experienced a moderate volatility compared to the previous decades. And here's this, I talk about this a lot, standard deviation. And this is for the S&P 500 index by standard deviation. How many, basically 3 times this number right here, 99.8% of the time, this is your annualized rate of return, 13.5% around for that decade. That means 99.8% of the time you had within 3 times this amount on the positive or the negative. That's tough. So again, we just take our 12.46. Oops, 12.46. We times that by 3. Oops, 12.46 times by 3. We had plus 13, so we got 37.38 is 3 standard deviations. 30, we'll just say 38% or 37% for simplicity. And we'll say this is 13. So 37 plus 13 is 50. So 99.8% of the time in any given year, you had no more than 50% rate of return with that for those 2 things right there. Now we take 37% and we subtract by this amount because the annual return is on the positive. That gives us 37% That's 26%. All right, so 99.8% of the time you had negative 26 or positive 50 in a standard deviation component, if that makes sense. Now, the decade before, we have 16.3, all right, 16.13 times 3. So that means we had, we'll say 48% is our standard deviation here. So here we had 99.8% of the time, we take 48, we subtract a point here because that's on the negative. So we had 47%. 99.8% of the time, you got no better than 47% on the positive, and we take 48, subtract, we add by that, so or negative 49% on the negative. So you're basically between negative 49 or negative 47 on the positive, 99% of the time. But here's the interesting thing. We have 9 decades. 2 of those had negative returns. All right, so that's 2 divided by 9. That's 22% of the time we had negative returns in any annualized decade. Now, the markets don't care if it's 1930 to 1939, 1931 to 1940. They don't care. But just from this statistical perspective, we have 9 decade times, and again, the decades usually from the aughts to the nines. 22% of the time we've had negative returns. Not much, but factor in, well, there wasn't inflation here. So factor inflation is actually a positive return here. But inflation, these other ones, this is certainly negative. I think 70s were negative factor inflation too. In fact, I know they were. 60s were about 3%, I bet, all right, after inflation. Either way, then you factor taxes, certainly negative, negative, negative. Probably breaking even there. But anyway, so basically the returns of the S&P 500 are based on 1, 2, 3, 4 solid decades. The 50s after World War II, the 80s with Ronald Reagan because of Jimmy Carter helping out with deregulating stuff. The 90s because of Clinton, I'd still say because of the economic boom of Reagan. And then the 10s, we could say because of Obama. I'd say because of fracking, whatever, I don't care. But at the end of the day, you got to wonder, what's the normal? We got 1, 2, 3, 4, 5 single digit to negative returns. So we've had more single digit to negative returns than we've had double digit returns. Isn't that interesting? Yeah, look, standard deviation 11, standard deviation of 12, standard deviation of 12. So actually this decade past was the 3rd lowest in standard deviation of the previous time. So it's still 33% was still, that's not, other than the Great Depression, standard deviation was pretty close to what we looked at in last decade. I want to show you something. So what I'm using for standard deviation, I want to go to investments and the right capital, total stock. I'm using 17.3 total stock index. That's the standard deviation we're doing for the right capital. If we go to all bonds, well, I don't know why 4.6. But if we go to let's go to aggressive here, which is 90-10. 14.8. So my standard deviation is much higher than historical norms. Yeah, other than this 1 year for the total stock index, we've never had a standard. Again, this is S&P 500. I get that, but still a lot of similarities. My standard deviation is 17, which is higher than anything other than the Great Depression decade. I just find that interesting. So anyway, it's interesting here because people say, "Oh, I get a 12% rate of return on annual," and I think so. Look, check this out too. 1, 2, 3, 4, 5 years. So these the first 50 years of the 30s to basically the modern era of investing really starts in 1926. But let's say we got negative. We got 9 plus 19 plus 8 plus 6 divided by 5. That gives us an 8.4% average rate of return. All right, 8.4%. Now we go in these last 4 decades, 17 plus 18 plus negative, minus 1 plus 13 divided by 4. So we've had 11.75. So 11.75 minus 8.4 divided by 8.4. The last, since I've been alive, no, that's not true. Since 1980, 39.8% more. So the last 4 decades have returned 39.8% more than the previous 5 decades on average. You notice too that this is the beginning of the corporatist, globalist agenda as well. How long can that go? Hey, let's keep reading. Let's see, because I want to show you something that I take huge issue with. Benefits of diversification. If you committed to a global diversified portfolio and to areas of the market associated with high returns, small cap stocks and value stocks were challenged over the past decade, as shown in Exhibit 3. The past decades, okay, so value stocks here. Oh, yeah, this is good. So value stocks in 2010 were here. Growth stocks were much better. So growth stocks average over 15, while value stocks average just over 10. Yeah, maybe about 12. So growth stocks smoked value stocks. But in the 2000s, growth stocks got smoked by value stocks. Value stocks are positive, Wellington. Growth stocks are negative. Isn't that interesting? Small did small did better than anything else. Small did better than large in the aughts. Small did better than growth in the aughts. All right, so small value did best in the aughts for sure. That's for small value did best, and small value did worse in 2010. It's just, I mean, that decade. So it's just everything reversed the mean. Developed U.S. stocks, ex-U.S. stocks, and you can see that. Look, emerging markets did great in the aughts, but they did horribly in the tens. All right, so here, let's see. I want to show you this right here. Okay, good. So anyway, the point was everything kind of ebbs and flows decade to decade, which is why I'm not getting rid of my value stocks. I believe in them. In fact, I was reading, I think DFA, as a matter of fact, they said value stocks beat growth stocks 83% of the time or 83% of the decades. I can't remember, but it's a significant amount. The performance of value versus growth and small versus large also vary between decades, and we talked about that. Value underperformed growth in all three market regions, despite underperforming large cap and growth in the U.S. small cap, and value delivered basically 12% respectively for the decades. That's pretty good. Now, here's a cumulative investment. Look, I'm telling you, so a lot of people are going to look at this and say, I need to be in emerging markets. The problem, the cumulative investment is silly. That would be if you dump some money in on 1 January 2000 and you woke up at 31 December 2019. I don't like these annualized things because it's you got to look at year over year and cash flow going in, cash flow going out. I don't know anyone. I mean, very, very few people who just dump money in when they're 45 years old. They come back up when they're 65. Say, okay, here's what I got. It doesn't work like that. People are adding to it, taking money out, adding to it. If you're building at wealth and while you're working, you're adding to your portfolio. I hate to say it, but if you miss over 20 years, of course, this is the whole thing with the Dow bar study. So if you've been in your investments for the last 8, well, you've certainly done worse than the investments themselves over 20 because you didn't have any money in it. Does that make sense? So basically, you're like, okay, emerging markets have done well, but I haven't done well. That means be a bad investor. No, it doesn't make you a bad investor. It just says at the end of the day, you weren't in the thing for the whole time. It's stupid. Or you only had $20 because you're doing $20 a month or something like that. And now you got $1 million, but you had to start with $20 in 2020, the year 1 January 2000. But that's not enough to get any value out of it in terms of growth. I've always hated these annualized returns. Like, I know it sounds good, but there's no one that just dumps money in. A retiree isn't doing that because a retiree is pulling money out. If you're working, you put money in. So this, it's crazy. It should be about cash flow. Anyway, so that's pretty good. I just want to share that with you. All right. Despite all uncertainty, fundamentals of investing have endured diversity among markets and asset groups. And I'd say intellectual diversity, college campuses. You hear me? Don't try to predict the future performance of time the markets. I agree. All right. Well, I thought you'd find that interesting. I'll put a link in the show notes. Tell me your comments, man. Tell me your comments. We'll see how this shakes out for the next decade, the 20s. We're back in the roaring 20s. All right. We'll see ya.